Hi everyone and welcome to this new episode of Lux Job Insight. Once again, in the realm of ManCos, today we shall talk about the function of risk management. To give you a little background, CSSF Circular 07308 is one of the most important since the latter has been defining and overseeing the risk management function for UCITS funds since 2007. The aim is to identify and understand the risks to which the funds and their investors are exposed to, depending on their investment strategies, the type of assets, and more broadly speaking, the operational context of the fund. Following which, it's all about measuring and reporting these risks. It is important to note that the CSSF mainly determines the major outlines of what it expects in terms of reporting, calculation, etc. So, the risk function shall have its specificities in each ManCos in terms of process and methods, even if the best practices tend to spread and the differences decrease over time. Depending on the strategies and types of funds, for example from a 100% equity fund with derivatives to an illiquid fund investing in infrastructure, unlisted companies or in real estate, risk limits will be very different. In the case that risk limits have been exceeded, the risk manager approaches the investment manager or portfolio manager to inform him to ensure that the suitable actions are carried out to reduce these risks. So, what types of risks are we talking about? The CSSF lists out at least 5 different types of risks that it requests to cover: market risk, liquidity risk, counterparty risk, credit risk, and operational risk. Nowadays, we are noticing other risks that tend to become increasingly important, such as the risk related to sustainable investments or the risk related to computer fraud, for instance. Besides, we note that depending on the ManCos, the risk department will or will not integrate functions such as investment restrictions, compliance, or certain aspects related to the valuation of assets. So, the complexity lies in the constant evolution of the regulatory context, the tools, the financial assets, and different types of strategies. In fact, like often the case, a big distinction can be made depending on the type of funds which are being monitored, whether they are illiquid, regulated by AIFMD, or liquid, mainly UCITS. When it comes to UCITS funds, accessing information is usually easier. Their daily valuation and products are relatively standard for the most part. Automation is possible and much easier as well. And also, the data is more quantitative. On the other hand, when it comes to illiquid funds, accessing information can be much more complicated. The risk manager must investigate and analyze a particular file or a market to identify the risks. The data is more qualitative and subjective. The risk manager must therefore provide his own interpretation and analysis and assume his share of responsibility while managing these risks. Consequently, the tools, methods, and processes can be very different and are decisive when it comes to selecting a candidate for a position. Before talking about figures and salaries, we met with Loïc Guillermet, conducting officer in charge of the risk management function at Bill Manage Invest. Hi Loïc.
Hello Julien.
Thank you very much for accepting my invitation.
Thank you.
First of all, could you please describe us the organization of the risk management function at Bill Manage Invest?
Sure. Bill Manage Invest first. Bill Manage Invest is the fund company of Bill Group as a group. So it serves both the Bill products, Bill funds, and the third-party funds with external investment advisors or investment managers. So at Bill Manage Invest, we manage both what we call the UCITS products and also the AIF products with financial assets or non-financial assets. We have a good mix of those, and we actually have funds investing directly in private equity, directly in real estate, and directly in private debt. We serve approximately 30 clients. We manage more than 6 billion of assets under management. So To serve all this in the risk management function, we are organized around 5 risk managers. And they do also investment restrictions checks. They also do the valuation of the assets because of the size of the company. The 5 risk managers are quite experienced, of course. 3 will be more senior than the others. And each of the risk managers will deal with financials, but also non-financial assets funds. There's no split, alternative, non-alternative.
Could you please be more specific and tell us more about the typical day of a risk manager at Bill Manage Invest?
Yes, considering our size and that we act as a third-party ManCo, we implemented a client-centric approach in the team. So that means each risk manager has its own portfolio of clients or funds. And I believe that the risk manager will be much better in his or her task if she or he has the full picture. And that means an experienced risk manager in my team will cover all aspects, from the due diligences at the onboarding phase to the review of the annual reports at the very end of the value chain. That includes the monitoring of the limits, the interactions with the investment manager or investment advisor sometimes, the attendance at the board meetings and committees, the analysis, and of course, those risk managers will be supported by more junior risk managers to do all this. And in this context, you can imagine there's typically no day looks like another. You can easily jump from a call with a real estate manager to discuss liquidity issues to assessing a value at risk model in the afternoon, and then in the day after presenting a comprehensive risk report to a full board of directors for a bigger CCAV. So there's no typical day.
Okay. To finish, I would like you to share with us your view on the evolution and the trends in the ManCo risk function in Luxembourg.
Well, I can speak for myself and what I've seen. So I'm in this since 2006. And what I see is that in the early days, we had this CSF circular, quite famous in 2007. We look at the regulatory framework and the market practice and what we consider as risks today. It's quite amazing how it developed. It's more and more difficult to get a one-fits-all type of risk model or risk indicators. And therefore, it's really difficult to limit the perimeter of the risk function. So indeed, the finance industry is quite creative, innovative. There's always new idea of strategies or new type of assets to invest in. So that means for the risk manager, there's always a new room to identify new type of risks depending on those new strategies, and then assess those risks and report them. And the global environment also play a role. Sustainability risk is quite trendy nowadays, so it's not a new risk, but it's a risk that we pay more attention to today. And well, it's even embedded into the regulatory framework. And at the ManCo level, there are also new type of risks such as cyber criminality, and the risk manager is, of course, involved in all those type of risks. He needs to cover all those aspects. So the trend for me is that creativity is more and more needed, and adaptation skills is more and more required for risk managers in the ManCo environment.
Loic, thank you very much for these insightful details.
Thank you. Thank you for the invitation.
Risk management is one of the functions for which talent resourcing recruits most often. Volumes are stable, and in 2020 we have recruited 3 different profiles in asset management. All of them were already working as risk managers. The selection was made mainly on the type of assets which were monitored and the type of ManCo in which they worked. 2 of them were third-party ManCos, and 1 was an international asset manager belonging to a bank, organized in a decentralized manner in Europe, with more important assets under management. These led to a greater segmentation of tasks than in a small third-party ManCo, for example, where versatility is key. Among traditional large international asset managers historically dedicated to listed assets, illiquid strategies are often much less developed than within third-party ManCos, which have grown more recently as they confronted an already very mature UCITS market. Therefore, it is only logical that these third-party ManCos strategically focus on illiquid funds. Market demand follows the trend in terms of asset development. This explains why it's all the more difficult to find profiles with the necessary expertise in alternative funds, especially when we are aware of the major responsibility of the risk manager and his share of freedom in interpreting qualitative data on this fund type. Therefore, we advise you not to underestimate the profiles which come from small companies, as they are polyvalent and often manage a fund portfolio with varied strategies. Also because sometimes these include a strong customer relationship dimension into their responsibilities. It's interesting to note as well that a profile with proven experience of several years in illiquid funds may be valued up to 20% more than a purely UCITS risk manager profile. For average salaries, we have created two different categories. Risk managers with 2 to 5 years of experience in risk, average salary amounting to 76k euros per year, excluding bonuses and benefits. And risk managers with more than 5 years of experience in risk, average salary amounting to 87k euros per year, excluding bonuses and benefits as well. It should be noted as well that more or less 30% of them have the FRM certification, and even if we do not consider this certification as a particular asset in the salary negotiation, we definitely notice a bigger interest of employers doing job interviews in candidates who passed this certification. Well, this video is coming to an end. Thank you very much for watching and see you next time for a new Lux Job Insight.